Hey guys, Jared Wesley of Live Traders here. I hope everybody is well. I have two things that I want to go over with you guys today. One is the $600 that I made on Tesla today. So I recorded the open. You'll get to see the two trades that I took. One was just a $20, $30 winner, and the other was Tesla, which was about a $600 winner. So I recorded the open live, and I'll kind of splice that up for you guys so you can see my actual trade on Tesla. And then also I did a really nice lecture today on psychology and level 2. It's about an hour long. I know it's a little bit long. Most of you guys don't want to sit around and watch that. But I put that whole lecture in this video, guys. So after I'm finished talking here, go over to the desk. You'll see my live trading on Tesla. That's about 3 to 5 minutes. And then an hour-long lecture on psychology and level 2. You guys, you don't want to miss this. It's a really good lecture. A lot of people don't talk about level 2, and level 2 is really important. How you get filled on trades, liquidity, spread, bid, ask, how much room to give a stock, what types of orders to use, limit, market, stop limit, etc., and so forth. All right. So again, stick around for that. So you'll get to see the live trading on Tesla, how I made $600 on that in about 5-10 minutes, and then also an hour-long presentation on psychology, guys. Fear, greed, the need to be right. It's very, very good, very informative, and then obviously level 2 as well. So enjoy the presentation, and I'll catch up with you guys again soon. As I'm going to add a little Tesla at 301. Okay. And then I'm going to add a little more at 302 if it gets there. It may not. It's pulling back right now, guys, on this. But I'm going to put that out there like that and just to see what happens. Tesla, guys, I told you I was going to add some right at 301, okay? So I've added some Tesla, and I'm going to look to add more at 302. All right, so I'm going to get full on Tesla, guys, at 302. Just FYI, at 302, I'm getting full on Tesla. Guys, I'm going to be full on Tesla here at 302, right there. Okay? I have a $2 stop now on Tesla, which means basically low of the day. Okay? Target on this is far, far away. All right, there we go. All right, guys, so Tesla target, we need a lot, okay? We need like 305. Tesla stop break even, guys. Wow, is it going to really tag us at break even that quick? Tesla stop break even, guys. For me, that's 301.35, but, you know, follow your rules. It was up 405 bucks. Hopefully we can get another run up top here. All right, down to my last 100 shares of Tesla, guys. Okay. So that locks in a half of an R. And for me, full target it's going to be 305. Come on, baby. Here we go. Come on. There we go. Locked in a little more. And all right, guys. I'm going to walk on Tesla here next bounce. All right, there we go. All right, I'm done here, guys. Tesla can come back up. That's actually full target. I honestly only got 1R out of this thing. Actually, I got a little more than that. There we go. All right, out Tesla, guys. Out Tesla for 1.25R. I was only risking about 400 bucks on this, so I don't know what that comes out to. 1.3R. 1.35R. So, all right, I mean, you guys had plenty of time to get it. I should have readjusted the order better for you guys. Does that make sense? Meaning, when I said 302 by 299.90, I should have readjusted the order better. See it? Meaning the 2 minute. I'm going to take a look at Juniper in a second. See it right there? We should, and I nibbled some there, right? I told you guys, hey, I'm going to nibble some here. And I did. I got 301 some. I got 302 some. And you could have added at 303. But anyway, if I had held perfectly, I would have actually got about 800 bucks out of it, something like that. Okay, guys, so today's topic is psychology and level 2. Some of you might think that's a strange combination, psychology and level 2. Maybe, perhaps, right? Psychology obviously is the foundation for everything you do as a trader. It really ultimately determines your success and failure as a trader. And I understand, to many folks, it's a relatively boring topic, right? When you think about it, you're like, psychology. Everybody always wants to look at chart slides, right? That's what everybody wants to look at all of the time, and I get that, right? Charts are kind of sexy, they're interesting, they're fun, whereas psychology is like somebody talking you to death, but yet making good points. Level 2 is a topic that gets very little exposure in this business, and I find it very fascinating that it gets such little exposure, and the reason being is because if you don't understand at least level 2 on a basic level, you're not going to make any money in this business. And you ask yourself, well, why? Because you're not going to get filled. I mean, even folks that understand level 2, and we talk in professional trading strategies, there's a whole chapter on level 2, and yet there's still many of you out there that are still getting skipped on trades. Today, for example, when we were looking at can't remember the symbol, that ANTX or whatever the heck it was, really spready stock. I mean, it took 30 cents to get filled on that, and that was with anticipating it. Right? So there's a lot of you getting skipped on trades, and you're more likely to get skipped on the really good ones because they build up so much momentum with the institutional money behind them. So I find that these two topics, psychology and level 2, are very important. One, because it is the core belief and principle of how your trading actually goes, is psychology. And level 2 is the physical act of getting filled on a position. Guys, a position is only as good as how many shares you can get filled on. If you can't get filled on it, it's not a good trade. Tell me I'm wrong. If you can't get filled for the amount of shares you would like to get, you're trying to get 1,000 shares, you get 100. Well, that trade's garbage now. You got 10 times less shares than you wanted. It's garbage. So level 2, you could argue, is up there amongst the most popular, important topics that we go through in trading. Okay? What you guys have to understand in trading, I'm not going to read this slide verbatim, okay, is that its very core, trading is simply a game of statistical probability. If you don't understand that sentence, you cannot be a great trader. Okay? I don't want to hear it from all the people out there that say, oh, I have a 90% batting average or 95. Bullshit. Okay? Just move along. Okay? Trading is just a game where great patterns fail, poor patterns work, great patterns work, bad patterns fail. The patterns that we look at, okay, and I don't care what anybody in this industry says. I don't. I really don't. I've been doing this too long. What I mean by that, guys, is this. The edge we have is very small. I know people want to tell you that the edge they have is huge and use my trading method because my edge is the best. Bullshit. Okay? Between all the different styles of trading, there are definite differences out there, but the differences aren't quite as big as you think. All right, most people nowadays are trading the market open. If you're an intraday trader, you're trading the market open. It's the most popular time of the day to trade. It always has been, but lately, the last 5 years, 3 years, it's gotten really popular. People are looking at gappers, earnings, those types of things, and they're using those gaps to gain an edge. And once they get the gap, they're looking for a pattern, a 3-bar play, a buy setup, a climactic, a breakout, whatever. Guys, there's not that much of an edge in those patterns. And if you think I'm wrong, go take a look at your batting average at 52%, 59%, 47%. How much of an edge do you really have if you're batting around 50%? Right? So the edge we have is a valuable edge, but it's a small edge. So the key to making money is being consistent. Doing the same thing over and over again. If you mess with that, you're in big trouble. Because the edge isn't big enough that you're able to mess with that and get away with it most of the time. All right? So at its very core, trading is simply a game of statistical probability. That is it. Every trade, entry, stop, target. Entry, stop, target. Okay? So it's a very simple comment, but it's a very important one. All right? That's the edge. Statistical probability combined with consistency, right? So it's a game of statistical probability. It's nothing more. It's nothing less. The sooner you believe it, the sooner you make money. Guys, it's not always the perfect chart pattern that works. It's just consistency, all right? It's just consistency. And that's across the board with chart pattern, with money management, with trade management. If your plan says after 3 consecutive losers you quit, then you quit. If your plan says your target is 2 to 1, you're risking $100, your target is 200. You're risking 1,000, your target's 2,000. You quit when you get 2,000. That's what your plan says. Don't go against your plan. It's just all about being consistent. So this really comes down to what we always say around here at Live Traders is trading is simple, but it's not easy, right? It's simple to look at a breakout or a buy setup. It's simple to know that your target is 2 to 1. But it's not easy to get the 2 to 1. For example, today on Tesla, I got out of that too soon. Should have made $800 or $900. I made $550 or $600 or whatever it was. Okay, simple, but it wasn't easy. Got a little jittery on it. Okay. At the end of the day, or the beginning of the day, whatever you want to call it, guys, this is the stuff that bores the hell out of people. People hate slides like this or roadmap to success, but yet this is the entire business, right? The first bullet point there, trading as a business, treat it like one. 98% of traders fail this. You don't even need to go down the rest of the list. You failed and lost money because the number one bullet point at the top. I'm sorry, guys. You know me. I like to call things pretty direct, and sometimes I ruffle some feathers. Most people are just pikers. They're just hackers, man. Most people that come into this business, it's just a passing phase in their life. They're not really taking this seriously. They're not really seeing themselves as a genuinely professional trader for the next 20 years. It's just, oh man, so-and-so told me that they make like $1,000 a day, a couple $100,000 a year doing that. And like they do it in their pajamas from their office and like they can do it from anywhere in the world. And it sounds pretty neat. Can you teach me? I get emails and DMs on Instagram all the time from comments just like that. It's depressing. They turn me off. This is a business. Whether you're starting a coffee shop, a restaurant, a car repair shop, whether you're starting Apple Computer or Microsoft in your garage, this is a business. Make no mistake about it. It's one of the most challenging businesses you will ever try in your entire life. I promise you. And those of you who have tried it know what I'm talking about. So when I say treat it like a business, ask yourself, would you fire yourself? If you were working for you, okay, would you fire yourself if you saw what you were doing as a trader? The answer for most of you should be yes. Are you tracking your trades every day? Many of you aren't. Do you have a trading plan? Many of you don't have one, and the ones that do have it don't follow it. Okay, are you following the rules in your plan with money management, trade management? No. All right, are you getting a proper education? I don't just mean buying stuff. I mean market education too. Experience education, right? The stuff that you can't buy, the experience part of it. Are you talking to other traders? Are you reading as much information as you can get your hands on? No. The answer is no. And if you do, you do it for 3 to 6 months and you think, oh, well, magically I should be a great trader now. Why aren't I successful yet? Rome wasn't built in a day, and most people don't get rich overnight in any business, period. Okay. So I'm going to go down this list quickly. The first one is the most important one, though. One, guys, choose a defined method. Immerse yourself in it. Really. I don't care what the method is. It doesn't have to be live traders. I really don't care. All right. Choose a time frame you'd like to trade in. All right. I see a lot of traders mixing time frames and trying to do this and trying. Look, if you're going to be a market open trader, pick the 1, 2, and 5 minute chart. Get really, really, really good at it and make money from it. Don't be a jack of all trades and a master of nothing. It's more important to be a master of one thing. Once you master that one thing, then you can branch out to other things and potentially make more money in other avenues. But master one thing first. Set the parameters for the stocks you're going to trade, guys. Are you going to trade New York stock and NASDAQ? What about Amex stocks? Are you going to trade ETFs? Maybe. I don't know. Are you going to trade 0 to Berkshire Hathaway? Or are you going to trade $5 to $100 stocks? Again, I don't care. I'm just saying put parameters out there. Are you going to trade stocks with at least 1 million shares a day, or you don't mind trading stocks with 200,000 or 300,000 shares? What about spreadiness, whippiness? All of those things you have to determine. I'm not going to go into them here because they're all laid out in professional trading strategies. Time your trades with the market internals. Try not to go, like right now the SPY is ripping. You probably don't want to short anything right now. It's probably not a good idea. Okay? That doesn't mean don't look for relative weakness. You're just not going to take it right now. Okay? Trade and money management guidelines. This is your entire trading world. All right? I say this all the time. You guys get tired of me saying it, but I'm going to say it again. Blowing up a trading account is not a badge of honor. It's just stupid. Blowing up a trading account is not a badge of honor. It's just stupid. You should never blow up a trading. It should never happen to you. Ever. Not ever. Why? Because your money management shouldn't allow it. If it happens, that means you risked too much money for your experience level. Right? Your risk got ahead of your experience. If you're new and you're not making money, $10 a trade. That's it. You lose $10. Guys, it takes a lot of $10 trades to blow up a trading account, doesn't it? It takes a hell of a lot of $10 trades to blow up a trading account. Therefore, you shouldn't be blowing up trading accounts. By the time you get to $200 risk, $500 risk, $1,000 risk, you should be comfortable enough, confident enough, consistent enough, and disciplined enough to not blow up an account. Right? So discipline and patience to follow your plan and your method. That is it. Okay? No such thing. The Holy Grail. What is the Holy Grail? As it says, guys, in trading terms, the Holy Grail is the search for the perfect system with the perfect set of parameters, indicators, and settings that makes money in any market and is easy to follow. It does not exist. The market is always changing. Okay? 1 month your plan makes $30,000 and the next month your plan makes $3,000. And then some months your plan loses $3,000 or $4,000. It's just the way it is. Okay? Now, I'm not saying to not refine or, clearly define your trading. You definitely should be refining your trading. Absolutely. Of course. Right? The Holy Grail is becoming consistent. Coming in every day looking for the same types of patterns with the same types of entries, right? And using what you know to work successful, right? But there's no such thing as something that works every day all the time. No trader wins all the time. Okay? I usually have 2 down months a year. I shouldn't say down months. Usually 1 down month and 1 break-even month a year. Every year. Every year it happens. I can't explain it. It just happens. I can't predict what month it's going to be because I used to think I knew. And then over the last 5-6 years, it's been a random month every year. 1 month it's August, one month it's February, or 1 year, sorry, it's August, 1 year it's February. And you sit there and go, it makes no rhyme or reason. I know. It's just the way it is. Okay? It's just the way it is. Consistency is what makes money. So I want you guys to take a look, all right, at this. I'm going to go through this quickly because I want to spend some time on level 2 and I don't want this to be a 3-hour lecture. All right? When we take a look at this chart, I think we can generally agree, regardless of your experience level as a trader or the methodology that you use as a trader, that this is a pretty nice consolidation breakdown, right? And if we take a look at this, you have a very narrow, tight base or range back to the declining moving average with a relative volume drop in the middle of the base. And this is what I call a ruler breakdown. What I mean by that is you can literally lay a ruler across it. It's that tight, right? It's just sitting there like I don't know, 67.80, 67.80, it's beautiful. It's gorgeous, right? Entry here, stop here, and boom. You're paid, and you're paid handsomely and quickly, right? The first 20 minutes of this trade, you're making good money, and then if you held it all day. Most traders can agree that that's a great pattern, I would think, right? If I were to ask a room full of people, is that a nice breakdown? Most people would say yes. And by most, I mean 80+%, okay? So we look right here. RL, nice tight consolidation, back to the rising moving average, relative volume drop, volume spike on the break above 142. So you get in at 142. This little arrow should be a little further over, but you get the point, right? Stop loss is like 141.60, 40 cents. Guys, 5 minutes, it's up over $1. So if you had a 40-cent risk on this and you're up $1.10, that's almost 3-to-1 on your money in 5 minutes. This is breaking above the prior pivot high. You're above all 3 moving averages. I don't really use moving averages, guys. I put them on my charts for you guys. I honestly, for those of you that are in the chat room here, you can see I don't really have moving averages on any of my charts. Point. Most people would say, hey, that's a pretty nice breakout if you're a breakout trader, okay? Not to be outdone, the pullback traders. So you have a stock that's up 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 bars. Pulls back where? Level 2 support or minor support, depending on which one you want to call it. Right at the rising moving average with a bottoming tail on a doji bar on a 50% retracement. The high is 72.40, the low is like 71.70, the middle's about 72. About 40, 50%, right? It's perfect. Where do you buy it? Right over here. Again, the arrow should be a little bit over here, right there. Right there. That's where you buy it. You buy it right there. I don't know, what's that, like 72.10, give or take? Stop 72? 10 cent stop. Yeah, I know it's a $72 stock, but point is, moves up almost 50 cents. 5-to-1 on your money in 30 minutes. Most people would look at that pattern and go, that's a really nice breakout in an uptrending stock at the rising moving average, at support. It's got a lot of location. It's beautiful, okay? Here's another breakout, right? Sits there, chop, 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 boom, right? Relative volume drop, volume spike. $64, your stop loss is 10 cents, guys. It goes up 5-to-1 on your money, 50, 60 cents. Okay? Then we can go here. Now you're going, oh, wait. What's this doing in here? It's not that great. It's okay, right? I mean, you have a little double, triple bottom support at 39.40. It's okay, but it's not great. Most people that would look at this would go, yeah, this is mediocre. It's not as nice as the last 3 or 4 charts you've shown. Guess what? I agree. The last 3 or 4 were much cleaner, tidier, prettier patterns. So what's the overall point here, guys, that I'm making? I'll take a look at a couple more, and then we're going to move on, okay? A couple more. Here we have a stock that tanked from $71 down to almost 60. Okay, that's on a 5-minute chart. That's a really nasty sell-off. Look how many wide-range red bars you have. Okay, look at the volume spike, guys. Look at the consolidation over here where this stock's doing like 50,000 shares per bar. Over here, it's doing 1 million shares per bar. It's doing 20-to-1 on the volume here. You get a bottoming tail, a green bar, and you get a climactic buy setup. Parabolic buy setup. Target, first target's moving average, second target's back at 70. Pretty nice pattern. Okay, now why am I showing you all this? And we'll do one more. Little sell setup, right? Stock gaps down. There's support here at 980. There's support here at 960. Gaps down and moves below, right? Moves below support, bounces back, right below the declining moving average. You get a change of color bar. It went from green to red. You get a topping tail right there. From the top of the pivot here to the bottom, that's about a 40% retracement drop. So we just looked at, I don't know how many charts, 7 or 8 charts, okay? And outside of perhaps one, they all look pretty good. And most people looking at them can identify that one chart. that didn't look so good. And the rest of them, you guys are going googly-eyed over. Wow, what a great breakout. Wow, what a great pullback buy setup. Wow, what a great climactic. And there's a lot of other patterns out there. So the next slide is, I'll say prophetic, but what you believe has a dramatic effect on your outlook in trading and in life. But I want to take it one step further than belief systems. Okay? You just looked at 8 or 9 slides of charts. And most people can sit there and go, yeah, that one's not as good as the rest. Like, what's the outlier here? All right, what's the pink elephant in the room? It was that ugly chart. Everything else looked really clean. So my question is simple. It's rhetorical, but simple. What's the problem? If you have no problem recognizing perfect patterns, and you had no problem recognizing a relatively sloppy pattern, why aren't y'all millionaires? It's an honest question. It's rhetorical, but honest. What's the problem? It's between your ears. So there's 2 issues here. One, some people don't think those charts are that nice. They have a different belief system of what a nice chart looks like. That's one, but that's a minority. Right? That group of people is a small group of people. Most people that look at those slides go, wow, those are nice. So let's talk about the majority, the 80 or 90 percenters. If you all can recognize those patterns are really pretty, what's the problem? Exactly. Discipline. You don't have the discipline to wait for your pitch. Why are great hitters in baseball great? They foul off the bad pitches, or let me check that. They let the bad pitches go, right? And the ones that they're like really close to maybe being perfect but not quite, they foul them off. And then the good ones, they crush. Most traders don't have the patience to wait for their pitch. They simply don't have the patience to wait for the perfect pattern. And a lot of you out there, and I'm talking to everybody, okay? You want to go into a trading room for action. I want the action. Excuse my language, guys, because I curse a lot. Fuck action. You should be here for money. You shouldn't be here for action. You should be here for money. Okay? But a lot of people want the action. Have you guys noticed, and I have seen this throughout my entire trading career, a lot of poker players become traders? A lot of poker players are traders. They want the action. I'm not in it for the action. I'm in it for the money. Okay? So stop looking for action and start thinking about money. Start imagining stacks, and I'm not joking, imagining stacks of $100 bills on your desk. And imagine every time you mess up, somebody takes a couple off your desk. A couple off your desk. You do something right, they put a few extra on your desk. Okay? Have 2 stacks, one made and one that you're about to lose, right? And see which pile goes to zero first. So what you believe has a dramatic effect on your outlook in trading. You're going, well, what exactly does that mean, Jared? What I mean, guys, is, you know, that saying out there, Jeff Yates uses a lot, is to know and not do is to not know. It's basically saying talk is cheap. You could sit here and say this stock looks higher or lower, but if you don't actually put your money where your mouth is, you don't really believe it. We all do it. It's just to what level do we do it, right? So your belief system is dramatic in this business. We get complacent sometimes. As soon as you see a stock go green, imagine you start getting clammy hands. Ooh, it might pull back. As soon as it goes red, you do the exact opposite. What is the exact opposite? It'll come back. I'm going to give it more room. It's counterproductive. It goes green and you go, I better get out before it goes red. It goes red and you say, I'll give it more room so it can go green. So wait, let me check myself here. The stock that looks like shit and is going lower and is red, you want to hold that. And the stock that's going green and it looks great, you want to get out of that. Now you wonder why 95+% of people lose money in this business. That is it. I just summed up psychology in 3 sentences. Because the crap that looks like crap you want to hold, and the stuff that looks great you want to get out of. Wow. Good luck making money in trading. Right? Good luck making money in this business. You won't. I understand it's not always easy. I get that. But do you see the conundrum here? I'll give it more room. It'll come back. What does it really come down to? It's not fear. It's not greed. It's the need to be right. See, if you get out of a stock that's green, you're right. It was green. You could tell the world, I made money on that. I was right. But if you get out of a stock that's red, you have to admit to the world you were wrong. Right? You have to admit to the world you were wrong. Newsflash. Most people have big egos and they lack objectivity. Right? Most people have a really big ego and they have terrible objectivity. They justify bullshit. Right? You can catch a kid's hand in a cookie jar and you're going to get some excuse. Instead of just saying, I'm sorry, I was wrong, you're going to get an excuse. It happens all the time in this world. All the time. Okay? People make excuses for things that are inexcusable. They kind of come up with a reason for it. Nobody cares in trading. Nobody cares. So you need to get away from this attitude of I need to be right. You know, in sales, they always say you can be right or you can be rich. Trading's no different. The need to be right will drive you bankrupt. The need to be right will drive you bankrupt. It'll blow up your account. So what you need in this business, guys, is something called mindfulness. Mindfulness is the capacity to be aware of your thoughts, beliefs, and biases in real time. Okay? Think about that. You need to be present, self-aware and present in real time. Why? Why? Because we all experience these emotions. We're human beings. We're not robots, although some people seem like robots. We are not. So you need to be aware when you get into a trade and it goes against, you need to be aware. Go, wait, okay, step back, Jared. Woosah. You have an entry, stop, and a target for a reason. This pullback is okay. And even if it's not okay, I have a stop loss in place for that. Meaning I have a solution. And the solution is not to worry. It's not to get out. It's to trust the plan. The mindfulness is saying to yourself, let it go. We prepared for this before we took the trade. We knew that this was a possibility. When we took this trade, there was the possibility it wasn't going to work. If you are not prepared for that possibility, newsflash, you shouldn't be in the trade. Period. End of discussion. There's really nothing else to say about that. Preparation for the worst is just as important as preparation for the best. Nobody wants to stop out, and I'm not saying you're going to be happy about it, but you need to accept it. We're all guilty of this from time to time. The only difference between the money makers and the money losers is the money makers do it very rarely, or if they do it, it's on a small scale. Targets $1,000, sell at $900, very small scale. Targets $1,000, sell at $200, that's a problem. Okay? So mindfulness, the capacity to be aware of your thoughts, beliefs, and biases in real time. Okay? Your thoughts and state of mind follow your emotion, right? Emotion doesn't follow thought. Emotion is just a reactionary thing, right? When stock goes against you, you immediately get upset. Oh, gosh, darn it, man. That's what you think. Then your thoughts, state of minds, and actions follow the emotion. The emotion is the trigger, and then the action, hopefully, is to hold, not get out of it, even if it does stop you out. And then the worst part is when it goes against you and you say, I should get out. And then it stops you out for a loss of money, and then you say to yourself, I knew I should have gotten out. So what do you do the next time? The next time it goes against you, you get out. And that's the time it pivots, goes higher, and hits your target. And now what are you doing? You're chasing your tail. And that is when people lose money. right? So emotions are triggered when there's a disruption of a familiar or established pattern. Guys, think about this. Emotions are triggered when there is a disruption of a familiar or established pattern. I want you to read that over and over and over and over and over again. Why? Because everything you do in trading has happened to you before. You've hit targets before. You've stopped out before. You've had slippage on entry before. You've had slippage on stop outs before. So emotions are triggered when there's a disruption of a familiar or established pattern. So why are traders so emotional? We've all stopped out on a trade before. We've all lost money before. That's familiar to us. We've all hit targets. That's familiar to us. But yet, most traders tend to be relatively emotional. I get emotional at times. I get jittery. I sell a little bit too soon. So realistically, we shouldn't be very emotional. You come in, you go, the most I can lose today is 3-1. Because if I hit it, I stop. My targets are 2-1. Whatever it is for your plan. And that's it. We know what's going to happen. So that should help keep the emotions in check. I'm not saying it always does, but it should help keep your emotions in check, knowing what your target, your entry, and your stop is. Okay? Rand Howe, we create our understanding of our world from our adaptations to our deepest fears and desires. The problem we have in trading, it's not trading at all. Trading is simply the mechanism that makes you feel a certain way. So what I mean by that, guys, is there's two problems here. The need to be right is an ego problem, right? Losing on a trade is an ego problem. It's not even the money most of the time. Guys, I have seen traders, and I've probably been there myself too. I have seen traders do the same thing on $10 risk as they do on $500 or $1,000 risk. Think about what I just said. Clearly, it's not the money. I mean, if you lose $10, I mean, you're gonna go live in a tent down by the river? I doubt it. So what's the problem? It's the need to be right. It has nothing to do with the money. That's one half of the people. And the other half of the traders are trying to pay their bills with no experience. You want too much too soon. Your expectations exceed your experience. Let me repeat so you get it. Your expectations exceed your experience. And that creates emotion. And that emotion creates problems for your trading, where you do things you shouldn't be doing. So half of the people, it's the need to be right. I just need to be right. It's not even the money. I've seen people do this with such small risk, it can't be the money. $5, $10. Who cares if you lose $5? Right? Guys, I mean, I've done that before. Right? Your plan says to get out of a trade, but it's like $10 under break even. And you know what? I'm not going to take the $10. I'm going to wait for it to pop above break even. I'm going to sell it for a 2-penny gain. And then what happens? It completely stops you out for minus 1,000 or minus 500. And you sit back and go, was that $10 really worth it? No. But it was the ego of closing out the trade in green versus losing $10 on it. I know I've done it. People out there, if they're honest with themselves, you've probably done it too. Crazy. Crazy. You're risking $500 on something and you're going to lose $10 and you go, no, I need to make $5 on this just so it's green. It's nuts. Okay? So we must develop mindfulness as a tool to examine our thoughts in the middle of a trade before we take a trade and after we've exited a trade. Okay? Otherwise, we lose objective perspective and begin the fear-based process all over again. Okay? Which ensures the same thing will happen the next time we're confronted with a similar situation. What does that really mean in layman's terms? It simply means traders typically repeat the processes, good and bad. Good and bad. You repeat good things, you repeat bad things. But for most traders, it's bad things because most of the things they do are negative based. Okay? This is a very emotional, psychological business, guys. Okay? And unless you can control that little thing between your two ears that we're supposed to have, a brain, unless you have mindfulness, objectivity, you'll never be a great trader. Okay? All right. So guys, there's more slides in here that I'd like to discuss, but I'm just not going to go over them right now. Okay? I'm going to go over one more thing, and then we're going to get into level 2. Goals. This is a huge issue. I'm going to skip right to the middle. Remember, outcome goals without process goals are just pipe dreams. I would say entering the trading business, this might be the number one problem that every trader has. I had it. You've probably had it. I knew what I wanted as an outcome, just didn't know what the process was going to be. Think about it. Think about the movie The Pursuit of Happiness, for those of you who have seen it. He's broke, he's poor, he's destitute. He's outside the Dean Witter building. A guy drives up, and I think it was a 348 Ferrari. Cool car. And he goes up to him and goes, "Man, what do you do?" Right? I don't know his exact sentence he used, but what do you do? What was he looking at? He was looking at the outcome. This guy drives a Ferrari, so he must be successful. It's not always true, but as a generalism, it probably is generally true. So he's looking at the outcome. He asked him the question to possibly learn the process. So everybody wants to get into trading because they see outcome. What's the outcome? I'm not going to work 80 hours a week. I'm going to be able to make a lot of money from my house. That's what they see as the outcome. I'm going to go make 6 figures, and I'm going to do it from my pajamas or anywhere I want in the world. They have no idea, none, what the process is to achieve the outcome. Well, if you don't know the process, you're never going to reach the outcome. Right? It's like I need to go to, I don't know, I need to find my way to Disneyland. I don't have a map, and I'm not going to ask anybody. Good luck finding Disneyland. Right? So, and that goes for anything. It's you see the pot of gold, but you don't know the roadmap to get to it. The pot of gold is the outcome, guys. Without the process, you're never going to get there. And this process comes back to treating this like a business. Everybody wants to make excuses. Okay? And guys, I'm at the point in life where I just don't care. I've gotten to that stage in life. I used to I used to be the type of person that wanted to save every last person. I don't care anymore. Why? Because people are going to do what they're going to do anyway. What am I saying here? What I'm saying is many of you will listen to what I'm saying. You'll listen to this and you'll watch the recording over and over. And it'll mean something to you. And then the other 90% will go, yeah, that makes a lot of sense. And as soon as they walk out of the room, it's gone. It's like people going to a Tony Robbins seminar. They're excited when they're in front of Tony. 2 weeks later, they get home. 3 weeks later, and they're back in the same damn rut. It's like that New Year's resolution to go to the gym. I think they have an actual number on it. I think they say 7 weeks, 6 weeks. 6 weeks after the New Year's resolution, 95% of people are back to doing what they used to do. Some of you are going to listen to this, and it's actually going to mean something. The rest of you are just going to be, oh yeah, that makes a lot of sense, and I'm going to try. And then trying isn't. You need to do. You know, I'll tell you to take this course, or I'll tell you to get a trading buddy, or read this book. You won't do it. Oh, it's too expensive. Oh, and guys, I'm not talking about live traders here. Fuck live traders. I'm talking about everybody. Somebody will tell you to do something, and you'll make an excuse why you can't. I don't have the time. I don't have the money. I don't have this. That's life. That's not trading. That's life in every business. So stop complaining about the 1% being the 1% because they were the people that didn't bitch about it. They went out and did it. Don't get me wrong. I'm not an idiot. There are some people that went out and tried their ass off and it didn't work. I'll give you that. But the vast majority of the people that didn't work their ass off and complained about the people that did. Okay? So, have a process goal for your outcome, not just in trading, but in life. You have to have a roadmap how you're going to get there. Don't just say, I want a Lamborghini. You got all these damn high school and college kids and kids in their 20s going, I want that, I want that, I want that. Well, how are you going to go get it? Figure out the process, and the outcome will take care of itself. And by the way, one last comment on this before I get into level 2. Doing anything just for the sole sake of money is a pretty shitty thing. Do it for the freedom. Do it for the flexibility. Do it for your family. Do it for your kids. But just to come in and say, I just want to make money. Most of those types of people don't get very far in life. There's got to be a passion, a desire behind it. I really mean that. That's not hoopla, hogwash, corny stuff. I mean that. You can't wake up every day and go, I hate my job. I'm hoping, and I want to be rich at the same time. They're conflicting ideas and they're hard to reconcile. Okay? All right. Whoo! All right. Level 2 considerations. I spent about 10 minutes longer on psychology than I wanted to, but nonetheless. And by the way, guys, that psychology that I just went through, that I just spent 30, 40 minutes on, that was like 4 pages out of about, I think the psychology chapter, no, the trade management level 2 chapter is the longest. The psychology chapter is one of the longest chapters in the book. It's like 60 pages, and I just went through 4 of them. We spent a long time on psychology in professional trading strategies because it's everything. Without it, you can't make money. So let's talk about level 2, guys. All right, level 2 is a topic that I don't want to say it's taboo. Everybody knows level 2, meaning what it is, right? Everybody has an order entry box. Everybody. But nobody is using it properly, I guess, is a good way to put it. So how can we get better fills on our trades? How can we actually get filled on trades? Level 2 is all of these things, all right? So these are some considerations when trying to get filled on your trades. What is the overall volume of the stock? What's the price of the stock? Guys, Amazon is going to have a bigger spread than Bank of America. One stock is whatever Amazon is, $1,600, and one stock's like 30. The spread and the whip of a stock. Okay? It's a lot harder to get filled on a stock that has a 50-cent spread than it is a stock that has a 2-cent spread. Okay? The size of your stop loss and your risk to reward. Yes, level 2 has a lot to do with this, and I'm going to discuss it in a minute. Okay? How many shares you need to get filled. How badly you want to get filled. This has everything to do with how much room you're going to give your limit order. And I see most people not giving their orders enough room. I mean, I see people out there, they have a $1 stop loss, a 15-cent spread, and they're giving the stock 3 pennies to get filled. You're not going to. And if you do, you just got lucky. Okay, so these 6 bullet points are very, very important in terms of getting filled. And I'm not going to go over. See, in the PTS course, each one of these is 2 or 3 pages long. So just these 6 bullet points represent like 15 to 20 pages. Okay? I don't have that time today. So what I want you guys and what I want to really focus on today is what I call the balance of power. It's the bid versus the ask. Okay? So if you have a large ask and a small bid, it's not ready to pop. What this means is, for those of you in and I'm going to show you some level 2 pictures here shortly, okay? The bid are the buyers and the ask are the sellers. Okay? Now, on the short side, it's the opposite, right? But the bid are the people bidding for the stock, saying, hey, I'm willing to pay this much. And the ask are the people selling, going, but I want this much. So you come into a stock and you say, well, I want to pay $51, right? That's what I'm willing to buy it for. I'm bidding for it at 51. And you're selling the product. And you're saying, no, I want 5102. You say, well, I don't want to pay 5102. All right, let's meet in the middle at 5101. So that's that tug of war, that auction, so to speak, that's going on. The bid and the ask, okay? The size of the spread. Guys, the size of the spread simply means the amount of pennies between the bid and the ask. I know that that's very elementary. I get it. But most people don't even recognize this. If they recognized it, they wouldn't be getting skipped. Right? So the size of the spread is simply, for example, the buyers are at 51, the sellers are at 51.02. It has a 2-cent spread. That's a tight spread, generally speaking, unless it's like a, $5 stock or something like that. Okay? You're going to have larger spreads on stocks like Google, Apple, PCLN, Amazon, Berkshire, etc. Okay? Be thankful, guys. When I first started in this business, they didn't do pennies. They did fractions, right? Quarters, halves, 3/8, teenies, right? 1/8, 1/16, teenies. At one point, the tightest spread you could get was 25 cents. Okay? And then it was down to 8 cents. The tightest spread you could get on any stock was 8 cents. Now they're pennies. We're lucky. We live in a great world now. Trade fees were $50 a trade, $25 a trade. Now they're $1 a trade, $3 a trade, $2 a trade. Cheap. We're lucky. So the total shares you see at 51 and your share size. So for example, if you need a lot of shares and you don't see a lot of shares at 51, guess what? You need to start your order sooner. Don't worry, I'm going to give you an example. So for example, if you're trying to get $51, that's the price you want to pay, and you need 5,000 shares, but you see 10,000 at 51, some people might mistake this and go, oh, well, I need 5 and they're showing 10. I'm going to get filled. You're not the only person in the world that's trying to get that stock. Okay? So let's take a look. All right. This is a ladder type of level 2. All right, guys, this is a ladder system level 2. All right, I'm not putting in the older style in here right now. Why? Because I use the ladder myself personally. All right, why? Because it's awesome. So right here, you have the buyers showing 5,733 shares. You have the sellers showing 53,729 shares, but in the middle is an 11-cent spread or 9-cent spread. Okay, depends on how you want to look at the spread. Okay, so you're sitting here going, how am I going to get filled on this? Well, when the bid starts creeping up, then you know the buyers are starting to do what? They're willing to pay more for it. Right now, you have kind of I hate to use this analogy, you have a government shutdown. You have Trump and Pelosi, and neither one of them wants to inch any closer. All right? Well, over here is what Trump did last week. He gave in a little, extended the government. So what did he do? He said, I'm willing to pay up. Pelosi said, I'm not. I'll get off the politics point. But you get my point. The point here is, notice, the sellers didn't move. The sellers are still sitting at 56. They're still sitting at 56 over here. But what has changed? The buyer said, I'm going to start to pay up. I'm going to pay up. I'm going to pay up. Now you have a situation where this stock is ready to pop. Stock is not going to pop here. You have to make a decision here. Okay? My general decision here, if the spread doesn't tighten, usually the spread will tighten. And when the spread tightens, that's your signal, it's getting ready to pop. And as the spread tightens, something else happens. As the spread tightens, the offer, which is the bid here, right? The ask, sorry, the bid. I'm confusing you guys. Sorry. The bid, my apologies. The bid right here increases. Notice it went from 5,700 to 16,000. The bid is increasing. Notice what's happening? The offer here, the ask, is getting smaller. So it had 53,000 over here, and it had already printed 23. Now it's down to 27,000. And now it's up to 56,000. So you can see it printed about 33,000 more shares. Why? Buyers are starting to pay up. They're starting to pay up. The ask is not changing here. They haven't moved from $56. They haven't budged. The buyers are starting to step up and pay 56, pay 56, pay 56. So this number is going to continually decrease. But here's the rub. If you put your order at 01 or 02 or 03, you're not going to get filled. You're going to get like 100 shares. Why? Because all the damn shares are at 5600. So once you take out the sellers, The buyers are gone, or the sellers are gone above it. What's that going to do to the stock? It's going to push the stock higher. Guys, I need you to understand this. It's important. The buyers are stepping up. They went to 90, 91, 92, 93, and they finally made it to 99 and 00, which means what? They really want this stock. They're willing to pay up 10 cents for it. The vast majority of the sellers are at 56.00. So there's two things happening here. Eager buyers and a block of sellers. What happens when you take out all the sellers? You have an eager group of buyers. They want this stock bad. And the sellers run out of shares to sell them. The stock pops. Because the other people are going, holy shit. They are so eager to buy this thing. I'm not going to sell at 03 or 04. I'm going to put my sell order way up here. Why? Because I can get more money for it. That's the psychology behind it. The buyers are proving they want the stock. They came from 55.89 all the way up to 55.99, and this number of sellers is decreasing, which means the buyers, as you can see, are increasing. So the buyers are increasing. The sellers are decreasing, and when the big block of sellers is gone, there's going to be some, just not very many sellers up here. What is the overall result? The result is simple. If you didn't take it at 59 or 50, if you didn't buy it at 59 or 56, if you didn't buy it at 55.99 or 56, if you didn't buy it here, you're not getting filled up here. If you do, you're getting a partial position. Liquidity vacuum. Exactly right. And you wonder why you get skipped. You're getting skipped because you're starting your order at 56.01 and you're giving it to 56.03. It's just not enough to get filled. It's just not enough to get filled. Got to give it more room and start your order sooner. Now, the concern? What if it doesn't break? What if, and it happens, it definitely happens, just not often, it's 10% of the time. What happens when this number keeps refreshing and refreshing and refreshing and refreshing, and they run out, their buyers get tired and they run out? Then the stock shakes lower. But that's about 10% of the time. You have to be willing to let that happen. Okay? Yeah, and sometimes the iceberg order gets eaten up, and when it does, the stock pops, because sometimes there's also hidden buyers that you don't see too. But most of the time, the iceberg orders get eaten up and they pop, but every once in a while they don't. But that's a risk you have to take. So, guys, real quick, this is an actual level 2. Okay, right here, 56. Right here, 56. Now watch. Watch what happens. 01, no shares printed. 02, 100 shares printed. 03, 400 shares printed, 430. 04, nothing, 100. Went from printing 92,000 shares at 56. 19 here. Look, between 98, 99, and 00, you got like 140,000 shares, give or take. And then what do you get in the 15 cents after it breaks? 20,000 maybe? And no real shares to at least 07, 10, that area. So you're either getting a partial fill, you're getting a late fill, or you're getting no fill. I'll repeat that. You're either going to get a partial fill, say you need 2,000 shares, you get 200. Or you're getting a very, very late fill, which is a full fill, like 56.10, or you're getting nothing, because maybe you only gave it 3 cents. And then 9 times out of 10, these are the ones that hit and run quickly. Why? Because of the commitment from the buyers. The ones you get skipped on are almost always the ones that work painlessly. That's why you got skipped. So what do? You get in before everybody else gets in. If you're concerned, what do? Take half, both before it breaks and half after it breaks. Worst case, at least you have a half lot. Worst case, at least you have a half of a lot. Okay? So it's really, really important that you understand. That was my knee. Back. One sec, guys. That really actually did genuinely hurt. So you have to understand where the buyers and sellers are. Okay? If you don't, you're not going to get filled on half your trades. Okay? Previous day has nothing to do with current level 2, right? Previous day has nothing to. There might be previous volume from yesterday. You know, maybe there's some hedge funds that are looking to get rid of this stock at 50. I don't know, but it has nothing to do. Remember now, we're not talking right now about charts. We're not talking about a resistance area at 56.05. We're simply talking about volume and level 2. If there's a huge resistance point at 56.10, you're probably not going to take the trade anyway. Right? Maybe you would. I don't know. Okay. Does it matter what ECN routes that you use? The answer is absolutely, unequivocally, yes. 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 Guys, there's like, I don't know, 30, 40 different routes. I don't have them on here on these slides. But some routes have almost no liquidity whatsoever. You want to be on EdgeX. You want to be on ARCA. You want to be on BATS. You want to be on the 5 largest ones, guys. Now, if you're trading on TradeStation, they have what they call Intelligent Route, which uses those routes, okay? But if you're on a platform where you choose every route you want, you're going to pay more for ARCA. But if you're a trader, let me put it this way. If you're a new trader who trades like 50 share lots, 100 share lots, the route won't make a big difference. If you're trading 500 share, 1,000 share, 5,000 share lots, you need a good ECN, guys. Okay, are you going to pay more for ARCA, BATS, EdgeX? Yeah, you're going to pay like $3 per 1,000 shares. All right. Now, some platforms like TradeStation do not charge ECN fees. Most do, and ECN fees can be expensive, right? But I'd rather be filled on a trade and pay an extra $5 than not get filled on the trade and give up 1,000. It's a fact, right? It's a fact. All right. All right, let me see here. If volume shows shares printed, and on the ask we saw less shares sitting at 56 ask area than volume. So are you saying that you're seeing a higher amount of bids than offers? So let's say you're seeing 10,000 bids and 2,000 asks. That's just an indication that it's likely to move higher. The balance of power has shifted and it's likely to move higher. Okay, so we're going to go through a couple examples here. 1,100 shares here, 17,000 at 51. This stock's not ready yet, right? You still have some sellers at 99, but you have most of your block at 51. Now take a look at the same stock 10 minutes later. Now what? The buyers are willing to pay up. They were not willing to pay up over here on the left. Now they're willing to pay up. And not only are they willing to pay up, they're willing to pay up, and there's more of them who over here got together with their buddies and said, you know what? I need your help. And they say, all right, I want in too. Looks like a good deal. Let's get in on this party. And right now, when these when this, what I call balance of power starts to shift, when this 6,000 goes to 10,000, 12,000, and this 15 goes down to 12,000, 10,000, that's when you're going to break, when the balance of power shifts. Okay? Guys, in professional trading strategy, I do like 5 or 6 pages just on the balance of power shifting. Okay? So take a look at some of these examples. Okay? I want you to take a look. 59,000, 281,000. It's not ready yet. Yes, it's tight. It's tight. But when this 281,000 starts to get eaten into, and here's the rub, guys. Here's the rub. Sometimes this happens in like 2 seconds. Literally, those 281,000 shares are gone. Most of the time, it doesn't happen that way. Most of the time, it doesn't happen that way. You can see the 280 go down to 250, down to 220, down to 200. And when you start seeing it get down to like 40 or 50, 60,000, you want to definitely make sure your order is in or you've already taken it. I don't like to time the level 2 anymore. I used to do that years ago, but sometimes if you're even 1 second off, you get filled way up here. Okay? All right? Let's see. For example, if the ask never shows more than 50,000, there's 100,000 volume printed at that price. Oh, they're just hidden shares. You can call, I hate when people use the word dark pools, but they actually are real. There's plenty of dark pools and unlisted things, guys. 99.9% of average traders, including myself, don't have access to dark pools. So if you see some trading educator telling you how they're getting filled on dark pools, they're lying out their ass. They are dark pools, essentially, guys, are big institution to big institution. Okay? Goldman to Merrill. Merrill to JP Morgan. Okay? So when you do that, you have to realize when somebody says that to you, if they're not an institutional trader, they're lying to you. All right. Some of these guys I see online on YouTube, the videos are going, oh, I was a dark pool. Bullshit. You're not in on a dark pool. Okay. Now there may be a dark pool in there. Okay. And they truthfully, in my opinion, should be illegal because when you see what they actually do, it's almost like high frequency trading machines. Much of what they do should be illegal, but it's the world we live in. Okay. All right, so when you see this, guys, 19,000 versus 80,000, what you're basically looking for is the 19,000 to go up to, say, 30,000, 40,000, and the 80,000 to drop to 50,000, 40,000. So what you want to ultimately see, how you know it's going to pop, is when the bid gets bigger than the offer, right? When the bid here is bigger than the ask over here, then you know it's going to break. But when this has 19,000 and there's 800,000 right here, it's not ready yet. Now remember, that I just spoke of could happen in 10 minutes, slowly chip away. It could happen in 2 seconds. Sometimes a massive block order comes in, eats up the 800,000 shares, and it rips. You don't know how it's going to happen. Okay? You just don't know. All right. Here, notice, it may not seem like a lot of volume, but 19,000 for a price point on this stock is a lot. Where did it print? 175.00, and then it printed almost nothing. You're not getting filled for at least 20 cents on this. Most of you are getting skipped. Why? You're putting your order at 175.01. You have to know you're not going to get filled there. When you see a spread this big and volume relatively thin, you got to start your order at 98.99.00. On a stock like Bank of America, you could probably put your order at 00 or 01 and you're going to get filled, unless there's a million shares sitting there. Look at this stock. 54,000 shares at 170 bucks and then almost nothing above it. You're not getting filled. Okay? Here's more of them. Notice they're far more prevalent at whole and half numbers. 108,000 shares printed at $87. Boom. You just got skipped. Or you got filled at $87.20. Here, 10,000 shares, almost 11,000 got filled at 120. Boom, you just got skipped or you got filled 20 cents late. And look at the spread. 15-cent spread. Look at this bad boy. Look at the spread. It's a whippy, spready stock, isn't it? Hello. But most of the shares before it popped printed at $16 or $15.99. Okay? On the matrix with TradeStation, guys, and here, let me show you the difference here. These are two different platforms. TradeStation is on the left. I believe this is Realtick on the right. But I want you to see something. These are two level 2s, and notice they're almost identical. They should be. Take a look. 234,000 shares, 237,000. So there's a few hidden shares. 60,000, 60,000. 35,000, 35,000. 48 here, 47 here. But notice they're almost identical. 57,236, 57,136. But I'm just showing you the difference between the level 2s. They're both ladder level 2s. In the PTS book, guys, I do have the regular old school level 2, and I go over level 1 on it, level 2 on it, all that stuff. So this is just for our lecture today, but in the course, obviously, this is way more in depth. I mean, this is like a 4-hour discussion. But the point I'm making is, When you say, how do you use the bid volume I see on the matrix? Very simple. The same way I explained. So now I look at this stock. Let's use this as an example. 234,000 versus 57. I know this thing's about to go higher. It's about to go up to 1535. Okay? Why? Because there's 5-to-1, 4-to-1 buyers versus sellers here. So I use it the exact same way. All right? So let me pull this off for a quick second. All right? Hold on. What do I have? Let's go to the level 2 here. Okay? I like to focus on half and whole numbers, guys, obviously, because that's a lot of my trading. I'm trying to look for something that's in that range, all right? Because I want to see if I can find something that shows a good level 2. Yeah, I don't have it today. So you can see this right here. This is about to put in a new high. This is a hard level 2 to read, right? There's no whole number here. You can see not a lot of volume up here, but when you get to a whole number, you're going to see an unusual amount of volume, all right? And you're going to see buyers and sellers. We saw it earlier today. Well, was it BA when it went and broke 390? Okay, and if we go to 390, I bet you on BA there's an extra amount of volume at 390. There. What's at 390, guys? 87,000 shares. Look above it, look below it. A lot less shares. Whole and half numbers. We're humans. They're psychological points. Okay? So when you get into an area like 390, you want to start seeing the bid and the offer, the bid and the ask tighten up. And you want to see how many shares are sitting there before it breaks. Now, if it breaks now, it's not going to mean anything. Why? It already broke that area. But I mean earlier today, before it broke, right? When we're talking about right here at 1035, 1038, that area. Okay? TUP is approaching a whole number. Let's take a look. Yeah, okay. So TUP would be a good example. Now, TUP is a bit exhausted, and this is probably going to be a failed breakdown. But what you're going to see when you get there is probably a boatload of shares, right? We're not there yet, but because it's so extended, it's not going to be nearly as meaningful. But it's sat here for a very, very, very long time. So my expectation here would be that TUP does put in a lot of volume. What you're going to see is instead of 200, 700 shares and 400 shares, you're going to see this go up to like 2,000, 3,000, 4,000 shares. And what's sitting at 00 is probably going to be like 50,000 shares, 40,000 shares. It'd be nice if it came down to that area. We could be here for hours. How do I know? Because this thing's been sitting in this area for about an hour. All right? But a different day, guys, a different time, I'll record, okay, the level 2 right at the whole and half number. In fact, I recorded the open today, so we could probably take a look at Tesla when it was at 303, right? We waited for Tesla to break 303. We could probably look at Tesla at 303. Okay, you can see when it's ready and when it's not. You know when it's ready when the bid and the offer tighten up and the shares start to get eaten into. Okay, but TUP is a good example. It's just not there yet. All right, so if it gets close, let me know. All right, but anyway, guys, those are the things you need to consider when looking at level 2. All right, I want to repeat. This is not a super crazy in-depth look at level 2. We went through 6 slides, okay? In the book, you're looking at 30 slides just on level 2, 40 slides just on level 2. So it's not overly complicated, but it's very important. We talk also about how much room to give your stop limit orders, what type of orders to use, limits versus stop markets. We also talk about ECN routes, which ones are more liquid, less liquid, the fees for ECN routes. Some ECN routes are really cheap. Some give bigger rebates than others. So there's a lot to take in trading. And I thought that today's topic was particularly pertinent and relevant because, well, if you get skipped on your favorite idea, it's no longer a good idea. Think about what I said there. If you get skipped on your favorite idea because you didn't give it enough room, it's no longer a good trade because you didn't get any shares of it, which means it wasn't possible to make money, and we're here to make money. So think about that. All right. So I hope you guys enjoyed that lecture. You know, put these out every Wednesday, guys. So I hope, like I said, a different topic each week, but I hope you guys enjoyed that. To get more great educational content, subscribe to the Live Traders YouTube channel. This way you'll get email alerts every time I upload a new video.